The species that relies heavily on China is the pheasant. This is one of the advice received when recent variances asked experts about the investment strategy in tech stocks amid the current market uncertainty. The current stock market is showing extreme volatility following tax policy changes and economic news. Former President Donald Trump caused a sudden drop in the stock market by announcing a higher level of tariffs than expected on April 2nd. However, as he reconsidered most of the tariffs, the market recovered its gains by the end of last week. The current market situation is set against the backdrop of the initial stages of a trade war between the two largest economies in the world. In such uncertainty, some investors may feel the urge to sell their stocks and exit the market. Steve Sosnick, chief strategist at Interactive Brokers, said in an interview with Barron's that investment strategies should vary depending on each individual's financial situation. The decision-making of individuals is greatly influenced by their situation, such as considering retirement, being able to make long-term investments, or thinking about buying a home. Steve Sosnick advised that money to be used in daily life or in the near future should never be invested in high-risk assets, and a certain amount should always be held in cash assets with low volatility. Various factors can affect technology stocks. Some companies are particularly dependent on imports from China. Typically, iPhone manufacturer Apple and e-commerce giant Amazon are affected. Fortunately, according to the United States Customs, some technical products including smartphones are exempted from some tariffs, but there are still products that maintain tariffs, and if additional tariffs are applied, the prices of these products can skyrocket, affecting consumer demand. Paul Sterling, the chief investment officer and top investor of Great Bay Management, advises to focus on companies that are not heavily dependent on imports from China. He noted that companies that have already moved their production lines to places like Vietnam or India have a better chance of recovering more quickly. Companies that rely on software and advertising sales are also exposed to risk due to the overall economic downturn. This is because there is a high possibility that companies will reduce their marketing or information technology budgets. John Belt, portfolio manager of Gabelli Funds, says that while the weight of tech stocks is too high at the point of entering the economic downturn, tech stocks with high defensive power can actually weather well. Belt particularly regards Microsoft as a safe asset among the 7 major tech stocks. In the software field, they are leading with servers and Intel, and these companies have recently launched generative artificial intelligence functions and are increasing productivity. Another promising stock is Netflix, which provides cheap content through an advertising-based fee system and is expected to maintain competitiveness even in uncertainty. The market volatility is expected to persist. In a few weeks, the earnings season for tech stocks will begin, and the market seems more interested in future guidance than this quarter's earnings itself. According to Robert Lugemwa, Chief Information Officer of Brave Eagle Wealth Management, in times of great uncertainty like now, companies may not even provide earnings forecasts, which could be worse. He added that since stock prices have already fallen a lot, it might be more effective to lower expectations and surprise with earnings later on. Experts advise that at this point, it might be more prudent to maintain existing holdings rather than adjusting the portfolio significantly. Paul Stelly said that if you're already invested in tech stocks, it's best to just hold on for now, and in the long run, tech stocks are still the engine of our economic growth and will eventually do well. He said that rather than trying to time the market now, if you look ahead to 3 years, 5 years, 10 years, you will ultimately be satisfied with yourself for not selling your stocks now. Mijun's comment: the upcoming earnings season is important in many ways for investors. Given the complex uncertainties like potential United States, China trade war, high interest rates, and economic slowdown concerns, companies will announce earnings, with the focus expected to be on future market guidance rather than just quarterly earnings. During earnings season, focus on the potential direction of companies' forecasts. Many companies may issue conservative guidance due to global economic uncertainties, which could potentially cause a short-term downturn, especially companies that rely on advertising revenue, such as Meta, Alphabet, or consumer spending-sensitive platform companies, are likely to be affected by the economic slowdown. Furthermore, companies with high dependency on China, especially those like Apple and Amazon with a large proportion of production input from China, are exposed to regulatory risks due to the ongoing trade war. In such situations, investors need to be cautious but also selective. In the near term, build a stable portfolio with gold hedging and high-margin companies. Some companies may inflate their performance at the point of announcement, and there may be a possibility of a surprise recovery afterwards, so you can consider the opportunity to buy at a low point following a temporary drop. In conclusion, this earnings season seems to be more about the company's prospects, interpretation, and overall response than short-term performance, and the market response will largely depend on it. Investors are thought to be more effective in increasing their weight in value stocks rather than focusing on growth stocks, while managing risk and focusing on tech stocks with strong fundamentals and potential for structural growth from a long-term perspective. It's not too late to boost ownership of highly volatile growth stocks even after the market shifts to an upward trend.
The person with me now is Jared Bernstein, a former economic advisor to Vice President Biden, an expert in economic policy, and a former chairman of the Economic Advisory Council, who really understands these questions the best. Trump imposed a 145% tax on Chinese-made products, which was expected to greatly burden tech companies. But why do you now see this as a restriction on tech products?
I think it's because the Trump administration is slowly realizing the reality of their actions and their consequences. Of course, we've seen that movement in the stock market, but their ability to absorb the loss of billions of dollars in the stock market has a pretty high threshold of pain. However, when that stock market downturn ultimately influenced the credit market, they realized the risk of actually causing a global financial problem. Since the United States Treasury is at the heart of the world's financial system, the global system, there is a fear that if it comes under threat, it could cause serious disruption to the system. That's why they made the decision to lower the prime rate. Now, especially with tech companies like Apple, we're starting to feel the reality, and we've also asked here. In fact, I think this is a good signal. It's good news. More of this should happen. It may seem like going back to the old ways, but now it just adds to the passive things.
Could we also add the point that taxes have taken a heavy toll on consumer confidence? Look at these two headlines. From insecurity to panic, consumer confidence has plummeted even more. There are headlines like this too. As taxes take their toll, Americans are scrimping to buy cassette iPhones and Christmas gifts. It's been 10 days since Trump's Liberation Day. A new face has emerged, but what will the situation be like 10 days later?
It's a really important point. Right now, we're talking about items exempted from new policy directives such as smartphones, computers, semiconductors, but still a 20% tax is imposed. This basic tax rate still applies. It's 10% in other countries, but in China, it remains at 20%. Consumers understand well that this actually means higher prices due to the tax. This point was made clearer in the Consumer Sentiment Survey after the tax increase. Consumers have been stressed for several years due to high prices, and many voters voted for Trump because he said he would lower prices. And they raised the prices. Clearly, many people do not agree. It then affected the next market, and we saw his supporters feeling uneasy. So it became difficult to find people who support this program. As I said at the beginning, this reality seems to be reflected again in the actions of the policy department.
Following what you just said, the Treasury explained on Wednesday that the 90-day delay is a part of President Trump's broad negotiation strategy. However, according to the report, President Trump has retreated after causing major turmoil in the equity market. President Trump has mentioned that people are nervous and worried about the equity market, but can you explain why the equity market is so important, and could this be the reason why President Trump has changed his direction? This
country has a debt equivalent to about 100% of its gross domestic product, and that amount is equivalent to $30 trillion. If the interest rate on that debt goes up by 1%, that's a new debt service cost of $300 billion. That's a lot of money. I saw a really worrying point for the second time. That's part of the internal structure of the market. In this power struggle, we saw the position of the United States national debt being threatened. United States national debt is a bond that forms the basis of the global financial market, and its position is under threat. Investors seem to think that the United States is not the safe haven I thought it was. I was saying that I would move my money to Germany. This kind of threat is very difficult to recover from. So when the Treasury Department, especially Scott Baucus and Rutnick, realized that the safety net was under threat, they strongly pressured Trump to take action. And the part that has to acknowledge his contribution is that it has become a little more realistic in the end.
When considering this round of negotiations, what will the market open on Monday? And what kind of aftermath will there be about how much volatility is there? So,
predicting where the market will go in the morning is really a difficult task. If I knew that, I'd be having this conversation in a much better house than the one I'm sitting in now. However, one thing that's certain these days is that if taxes go down a bit, the market goes up a bit. And if taxes go down a lot, the market goes up a lot. That's why it's only natural that the market responds. This change is a significant turning point. That's also why I said earlier that the news is a rumor. It's clear that it's worth emphasizing that about a quarter of Chinese imports are targeted for exemption by this measure. That's right. While the 20% tariff remains, it's a clear advance that it has escaped from the insanely high level of 145%, especially compared to the higher tariffs on imports from Taiwan, Malaysia, and Vietnam. With this adjustment, things are slowly returning to the normal level of the past, and the market will certainly welcome this kind of relief. However, the situation is far from over. There's still a long way to go.
yes, you're right. So, in my opinion, we'll meet again soon.
Thank you.